Hey everybody, JJ here. Bolt to the bus. So consumers' distrust in banks and the financial system has really taken a big jump here over the last few years. Not just in the United States, but also globally, and we're going to talk about that and the reasons why. Also some pretty obvious reasons why this may be the case and what you might want to look out for going down the road here. So let's get into it. All right, also, before we get started on today's topic, we had a previous video put out earlier about the housing market, and it's called The Housing Bubble That Never Goes Bust. And if you're into housing and concerned about real estate prices or just watching the market, you might want to check that video out. All right, but recent survey here, 1 in 5 Americans are stashing cash at home in fear of a recession. All right, now first of all, I'm surprised that this number is still low. Now this article kind of points to the fact that this is a lot of people, or 20% of people, choosing not to put their monies into the financial institutions. They're saying that's a big number. Now it appears on first look here, first glance, that people had forgotten what happened about 10 years ago now with the bank bailouts. And a lot of people, I think, somehow think that the banking system has been restructured to where there's no more risk, or risk of that happening again, where the banks become insolvent. Well, I'm sure that most of you know that with the recent events here, it's pretty easy to see that the banks are still hanging by a thin thread, so to speak, or skating on thin ice. And it appears that banks are pushing the loans to the limit again, maybe not the exact same way as they did in the financial crisis period, but when you look at the fact of all the overnight repo market operations that had to take place, it tells us that banks are pushing themselves very close to their lending requirements as far as the reserve requirements that banks have now. So 1 in 5 Americans, approximately 20%, stashing cash at home. Now this article goes on to talk about the risks of keeping cash at home. So anytime you make this type of decision, you want to balance out the risk versus the rewards, right? It would be pretty horrible to have your home broken into and get robbed and have thousands of dollars taken, and then in the meantime the banks were fine. No sort of banking crisis or bail-in or bailouts happened, or bank failures. Now I don't think they're going to let the banks fail. I do think there's a chance of bank bail-ins occurring. It's a very realistic a risk that I think people should consider, and we did a report on that a few months ago about the risks of bail-ins. And credit unions, while they may be less risky, they still engage in the fractional reserve lending system. So you have to look at each individual bank's reserves in order to really get down to it. There's no easy answer as to which one is better. But think about the other risks associated with keeping cash at home. You've got the risk of fire or catastrophic event, right? Flood, hurricane, tornado. Then of course you have theft, right? All kinds of things could happen in either situation, in the bank or with money at home. And this was a study that was put out by MetLife of over 8,000 adults age 18 or older. Okay, this article also goes on to say you're going to be missing out on compounded interest by not keeping your money in the bank. So you're going to be missing out on that 1 or 1.5% a year. Oh no, can't have that happen. So think about how high interest rates would have to be and how high the annual percentage yield would have to be to entice people to put their money in the banks. Right? If banks were only allowed to loan money that they actually had in reserves on a 1-to-1 ratio, one, they wouldn't need to be bailed out. You wouldn't have a liquidity crisis. But two, interest rates would be much higher because you'd have to give people a reason to put their money in the bank and not just go out and put it in the stock market or in somewhere else besides trying to save it. Right? Who knows? The annual percentage yields could be 10, 15, 20%. We don't know. We haven't had real price discovery here for decades. In this country, ever since 1913 technically. All right, so one, if we had that type of system where banks could only lend on a 1-to-1 ratio compared to their reserves, you would not have this distrust in banks, because you'd have much less risk of banks failing, because they're always going to have plenty of reserves to fall back on in case loans start defaulting or massive foreclosures start hitting those banks. Okay, you still have the risk of a bank run where people go to get their money out of the bank because of some sort of panic, and that could really drain liquidity and make it to where the banks actually still don't have enough reserves compared to the amount of loans they're putting out there. And that means banks would have to raise rates even more to entice people to keep their money in the bank and give people, again, a big enough return in order for them to be willing to take the risk on keeping their money in the bank. All right, so you take away this fractional reserve banking system, and you've got a whole new economic reality, a whole new world basically, economically and financially. Right? That would also put a leash on the loans that banks are loaning out, because they would have to actually accept the risk if there were massive defaults on the loans. So they'd have to be much more choosy as to who they give the money out to. And then some people say, well, if banks don't loan out money, no one can afford the homes because home prices are so high. Well, I think you got it backwards. The reason asset prices are so high, automobiles, home prices, is because people can borrow too much money. Right? It's pretty simple. Just look at the housing bubble back before the financial crisis. What happened when everybody and their little nephew could get a loan? Home prices shot up very quickly. And what happened when banks pulled back, when they reined in the bad loans, or they quit doing the bad loans, is home prices dropped. So it is a false demand scenario that creates these high asset prices and bubble prices. Right? Also, we have to talk about companies buying back their own stock. Imagine where the stock market would be if it weren't for all these buybacks. And again, corporations are taking out lots of debt at very low interest rates to buy back their own stock. And we know that we've witnessed record insider selling over the past year or two. And you think it's just a coincidence? Well, you might want to think again. It's probably not. Okay, let's zoom out a little bit to the world economy now. A third of the world's consumers are suddenly nervous to spend. So this is a global economic slowdown. It's not just because of the United States and the trade war. There wasn't a trade war between the U.S. and China back in the financial crisis. So why would that be the new cause of this economic slowdown that we're witnessing? Right? The globe, countries across the world are in debt to the central banks to the tune of about $250 trillion right now. And that was at that level or near that level, again, before the trade wars even started. But if you look at the mainstream media, they're going to try to point to the trade wars being the cause of all this. Right? Again, that's the way they do it. They want the people pointing to the other political party, and everybody points at each other, but not up to the top to see who's actually running the show here. Okay, also here's an article here. This is out of Business Insider, and it talks about how many people are not getting wage increases or raises, even though technically when you look at the unemployment number, which is a highly flawed number, but if you do look at the 50-year low unemployment at 3.5%, on first glance you would say, hey, there must be a demand for workers because unemployment is so low. But just the opposite is happening as to what you would think would be happening. You would think there would be a labor shortage and that companies would be motivated to offer bigger salaries or higher salaries and pay increases to keep employees. Okay, but it's just the opposite. We have still so many people out there that are desperate for a job. People are willing to take low pay because what's the alternative? They can work for themselves and be self-employed and have no health insurance in many cases. And trying to afford today's health insurance on your own without some sort of insurance or company-provided medical coverage is very, very challenging. Right? So it's this inflationary environment that's caused by the banking system and by government intervention, right? So think about if the government weren't backing student loans, if they weren't backing the medical system with all the Medicare and Medicaid, right? Hospitals, doctors, colleges, they would all have to come down on their prices because no one could actually afford to just pay cash for these services now for schools and in the medical field. Right? Also, UBS is out there with a study basically citing there's some red flags in the economy as far as Americans pulling back on their spending. Right? Here's a shot of a herd of people at Costco. And when consumers start pulling back on their spending, you're going to see big implications throughout the economy because it's about 70% of the economy right now, GDP, is consumer spending. It's right here. And what was uncovered here in this study is as many as 44% of consumers said their incomes did not cover expenses. Now that's up in the last year. So definitely a sign that the consumers are feeling more pinched nowadays. Right, and also look at this here. There's also signs that a tightening credit market is leading consumers to falsify parts of their loan applications. The number who say their mortgage applications aren't completely accurate increased by 2% now to 21%. Right, so we're seeing more people desperate for money, and you might remember the liar loans that we had back in the housing bubble. So it'd be interesting to see how many people they didn't catch falsifying the loans, right? So maybe this number here that they're catching people falsifying their loans. Maybe that's a small fraction, we don't know. But we do know that the banks, if they're too big to fail and they know they're just going to get bailed out or get a liquidity injection and free money thrown at them if something goes wrong, what's their incentive to really deny these loans? Okay, remember a few reports ago we talked about the no credit needed car loans, where people with no credit, people just out of high school without established credit history, are getting approved for car loans. So it's pretty crazy. So I'd like to hear from you on this one down in comments. What do you think? Should we be cautious and take money out of the bank? Is it a warning sign that so many people are keeping their money out of the bank and pulling back on their spending? Or should these people not worry because the central bank has these other banks propped up forever? They're never going to let them fail. There's never going to be any problems with the endless money printing machines behind the scenes. Nothing could ever go wrong, right? Is that what's happening? Let me know. Thanks for watching, everybody. Bye for now.